At the end of the day, financial services remains an emotional thing. It comes ultimately to personal choices, which I don't see AI dictating any financial institution, but I actually think that personal relationship is going to stay. The rest of it, the execution, all of that stuff is going to be a no-touch. AI can help you translate this old code base into very new, faster, cheaper, easier to maintain. Take away a legacy of 20 years of coding and IT in financial services. If you remove that, you propose it forward 10, 15 years, and that's the holy grail.
Welcome to the Rate of Flow podcast. Today's session is entitled AI on the Trading Floor, from Treasury GPT to Smart Liquidity. Capital markets desks are no strangers to algorithms, yet most firms still cite high cost and a lack of expertise as blockers to deeper AI adoption. Today, we unpack the real gains, from natural language treasury tools to self-optimizing liquidity engines, while cutting through the hype around magic black box trading to see what's working, what's not, and what a truly intelligent market could look like by 2030. Joining me today is Francois Denimal, Group Managing Director at FIS, who oversees global strategies for capital markets, treasury, and risk solutions. He leverages over 20 years of experience in the industry in banking, trading, and risk management. Today, I'm really excited to have Francois Denimal with us. Francois is a Group Managing Director at FIS, looking after global strategies for capital markets, treasury, and risk solutions. He has over 20 years of experience in banking, trading, and risk management, holding various roles at FIS and SunGard. Francois, great to have you here today.
Thanks for having me.
To start off with, let's go back in history and talk about what was the first time that you saw an algorithm being used within the trading environment, and what kind of impact did that have on you when you saw the kind of the trust in code that came from that?
Well, it's a very good question. So I'm an actuary by education, and I actually started work in a reinsurance company in Geneva, and at that time we were coding in our own PC on VB, and we were talking about the cost of running the models, which were effectively the bigger machine you can fit under your desk, and the faster processing time. I mean, that was 2004, so actually 20 years ago. If you fast forward it 15 years, like 5-6 years ago, within an FIS context, in the same world, in the insurance world, we basically have now models which are completely hosted in the cloud, and we're talking about SaaS, and we're talking about effectively farm computing, we're talking about GPUs. So it's radically different, and the pace, I would say, that space evolves is quite incredible, and it's set to continue, to be honest.
Yeah, the concept of AI, I think in 2004, I don't even know if that ever came up in a conversation, as opposed to today, where it's every conversation is around that, I guess.
Absolutely, yeah. I'm pretty sure some people dreamt about it in 2004.
Yes.
Today you can't avoid it, for sure.
One of the things that came out of the study that FIS recently did was that cost and talent ranked number 1 and 2 as the biggest challenges for adopting AI. So 73% of respondents cited cost and 64% cited talent. In your mind, which one actually kills more projects? What is the biggest challenge for AI, and what is stopping firms from adopting more, especially in the capital market space?
I actually think that from a pure infrastructure standpoint, that's a cost that financial institutions and technology companies actually understand that they need to onboard, knowing that some of that is going to go to waste given the very, very rapid evolution. But you need to take that train in terms of infrastructure and upgrade and go forward. The people cost is super important, because the industry, the AI industry, is and the professionalism, I would say, of the people is relatively new. And as a result, getting these people on board, finding the right talent, providing them with an environment in which they can actually flourish and develop the talent, develop AI, is to me the biggest cost. And there's always going to be an arbitrage of existing talent with existing skill sets which remain mainstream, versus investing into new and effectively creating that investment for future, I would say, future reward. There's a question of finding these talents, and there's a question of effectively fostering this talent and effectively getting an ROI on these talents, right? It's funny, I don't know, a couple of days ago, I heard Mark Zuckerberg, for example, paying more than $100 million package to effectively top AI engineers and data scientists, which tells you it puts a real cost and a real figure to effectively what an AI investment is if you want to make it real, right?
But that raises an interesting question. You mentioned waste and the ROI. Is this something that firms, particularly in capital markets, can sit on? Because within the financial industry, the first mover advantage isn't always there.
That's correct. Yeah.
If we look at payments or traditional banking, you're fine waiting on cloud until something else happens. But I think in the capital market space, when you think about high frequency trading and really on the pointy end of some of these trading strategies, you can't really sit around, right? So are firms looking at it in that way, that they have to move forward with AI solutions?
No, absolutely. I think there's a first mover advantage and there's a competitive advantage as well, right? I mean, the moment your competition is faster, better reach, and ultimately as cost of trading, cost of hosting models, cost of AI going down, it translates to the cost of the financial firm. It translates to competitiveness effectively. So the more you upgrade, the more you get into these investments, effectively, the more you become profitable, and you can pass through this effectively cost savings to your clients. So it is a question of remaining relevant. The moment you're making effectively an investment, you got to stay on it and you got to stay relevant. I mean, one of the discussions we had with our CEO last week, that was actually in Sydney, is basically AI is top priority. We know there's going to be a bit of an investment period to get up the curves, but this is required to basically be relevant, existent, and competitive in the next 10 years. This is the kind of horizon you need to think about in terms of investment in AI and Gen AI. This is the relevance of technology company as well as financial institution today. That's what it is, right?
So it's almost as if they don't invest in it properly today, they may not be around in 5 years to be the second mover.
Absolutely.
Because that window will have closed and they will have been beaten.
That's, to me, the way to think about it. If you think about a firm investing into AI, they're getting into hyper-personalization, for example, of structure for their clients, of specific investment advice, insurance advice, very, very dedicated to your client, versus someone who is, I would say, more traditional into stock picking and things like that. You're going to create this very imbalance between traditional firm and AI-enabled and powered firm. And that's to me, that's going to basically endanger the survival of these firms, right?
Yeah. It's amazing how I think one of the first experiments I did with AI was using it to model a portfolio. And I said, I'm, at the time, mid-40s and, 2 kids and want to retire in 15 years or whenever it was. Help me create a portfolio. And ChatGPT at the time rightfully said, hey, we're not equipped to give you this information because we don't know about, all of your holdings and everything else. But I forced it and I said, okay, well, just give me a generic. And it gave me, 5 or 6 ETFs, 4 of which I was already invested in, which was good news.
Good news.
Very, very similar to what a robo-advisor would provide around that. So that's just at the baseline of the customization that's available in that. Is that? I mean, we talk about ROI. What is the thing that you're seeing in clients that's really the ROI number that boards and management is looking at to justify investment in AI? Is it profitability? Is it cost savings? What is the number one thing or the number one driver that you're seeing?
I would say all of the above. Cost savings by far. Cost savings leads to profitability. But the idea is to be able to, I would say, in a pure technology fashion, very quickly remove some of this very heavy legacy cost and legacy code, which banks, insurance companies, trading firms need to carry forward for regulation purpose, for safekeeping purpose, and all of this stuff. The idea that AI can help you translate this old code base into very new, faster, cheaper, easier to maintain, easier to upgrade cost base. Again, you take away a whole lot legacy of 15, 20 years of coding and IT in financial services, which is not that old anyway. It's 50 years, but you carry 20 of that. If you remove that, you propose it forward 10, 15 years, your cost base goes down, your efficiency goes up, you're much more, I would say, nimble to any type of reaction. And that's a holy grail. If you can remove code base, very, very old code base of COBOL, for example, and all core banking system monolithics that are very difficult to effectively replace or move, that is definitely something every single financial institution is looking at. Because today, if you spend $100 million into your IT budget, the likelihood is 60 to 70% of that is simply dedicated to run whatever exists today and to keep the lights on. If you can reverse that and spend 20 to maintain and effectively 40, 50 to innovation, you can reduce by $20 effectively your IT budget and dedicate 50 to innovation. That's incredible if you think about it, right?
I think you have to have the $200 a month chat GPT to be able to do your whole core banking base again. I'd never thought about that because I'd done a core banking migration earlier on in my career when I was at Citi, and it was super painful. I mean, it was from start to finish. You can see why organizations, at least in that day and age, but yeah, I hadn't really thought about the idea of using AI to facilitate.
So today
transition.
you've got companies actually specializing using AI and super powerful chips to effectively translate old code, old language into something much lighter, much nimbler, which effectively you can call it a like for like from a functionality perspective, but that costs $10 to maintain, that costs $2. You invest effectively $5 in the middle and you get rid of, I don't know, 10 years or 15 years of legacy costs that you don't want to carry. And in a typical technology way, some of this stuff is very difficult to effectively find. The number of servers to run COBOL, if you think about mainframe, if you think about all these things, like developers are difficult to find. In the same way it's difficult to find AI developers, it is equally difficult to find people who can maintain thousands of lines of COBOL manually today.
Salary is about the same.
Pretty much. One is maintaining legacy, the other one is planning for the future, right?
Yeah. One of the other stats that came out of the study was 80% of respondents saw AI as a better way of fraud and risk management. Can you talk a little bit about that? I mean, I guess it's not surprising, right, that many people would see that as one of the opportunities. Where have you seen clients really look at leveraging AI for that?
Today, fraud management detection is basically based on deterministic models, right? So you've got your set of data, which is limited in nature. We're talking about, whatever you can capture. With very static deterministic model, sometimes with regulators' approval, things like that. Today, the set of data you can analyze is potentially 1,000 times bigger. Well, I don't have a real figure in mind, but the size of data you can actually capture and analyze is bigger. And the ability to move from a pure deterministic model, so basically a rule-based model, which is the case in most financial institutions today, to AI when you detect trends and you basically can detect new trends and new anomalies that you would not even detect on a rule-based model because it's not even looking for it, as AI would actually look for it. It would detect it, create a pattern, and try to understand with the amount of data it's got to effectively to be fed to understand the new pattern. So that's for sure. The danger is this, right? It is possible that hackers and people who actually want to enter into the system also use AI to do that. So you would have a competition of AI to combat fraud and AI to produce fraud. So that's, to me, something to look forward as well.
Yeah, I mean, that's a good point with the whole cyber angle of things. I think about the Nigerian scammers and they, one of the reasons that their emails are grammatically incorrect is they're trying to prey on more susceptible people, right? Because the scammers, just like us, have only 24 hours in the day. But all of a sudden, if you have AI that enables rapid responses, so the good guys and the bad guys have access to these tools. What considerations are you seeing clients put against that to ensure that they're staying ahead of the criminals that have access effectively to the same tools?
I think you will always have more power of innovation, more infrastructure, more, I would say, care in a financial institution or someone who is basically responsible to keep your money safe. As a scammer is, use whatever exists today, I don't want to say it's not organized because it is organized crime at the end of the day, but it is definitely not with the same financial power and technological power. So to me, I'll always see there's two things, right? There's obviously financial power, capital power, and you still have a regulator on top of it who is actually also looking at this. So there's multiple ways, if you want, to make sure that any type of fraud or any type of attack is thought about in different ways. There's also some very innovative stuff, which some of it we do in FIS is we try to be our own scammers and we try to break into our own systems to understand to which extent we could potentially be exposed if someone was very creative or using some different type of technology, if you want to go into our servers. So you can reverse role as well.
Yeah, white hat, I guess, within
Absolutely,
your organization. You mentioned regulators. You talk. I mean, is there one regulatory nuance that really is silently doubling the cost of AI implementation? Is there something that regulators are putting in place that's really hurting the adoption of AI within capital markets?
There's two ways to think about this. I think regulators, these regulators are always post facto. So something happened, they understand what happens, and they try to regulate it to make sure we stay within frames, and something which happened in the past is not going to happen in the future. The second one is emerging technologies like AI. And today, I think we are in a framework kind of approach. I think Europe just released something a couple of weeks ago, around a framework on regulation. I don't think it's at the stage of limiting financial institution or technology company to actually use and harness AI. I think it's at the stage of understanding it. Although, yes, regulation can be a cost, regulation can be a break if you want to innovation. In this case, I think we're still in discovery stage. But if something happened, effectively regulators will get into it, will understand it, and will put the brakes on where there is effectively a risk for the consumer or the firms using this kind of technology, right?
Yeah, to a certain extent, nobody knows really what is going to happen with this, which kind of brings me on to the next section of hype versus reality within capital markets and what's possible and what's not possible in this. From your view, which capital market task is least likely to be automated by 2030? So in other words, in the next 5 years, what do you think is not going to be touched by AI that will still be human-driven?
I will provide a very non-capital markets answer. The emotion part of the business, your risk appetite, your willingness to invest into something, your willingness to protect yourself against something. AI can give you a recommendation. AI can tell you this is what you should be doing. At the end of the day, financial services, on a B2B basis or on a consumer basis, is still to me, remains a personal business, a personal choice, and an emotional thing. If you want to protect your family and buy an insurance policy, which basically covers your family, you will. If you want to be aggressive in trading and effectively try to get capital gains, this is something you're going to do as well. And it comes ultimately to personal choices, which I don't see AI dictating how I'm going to wake up on a Tuesday morning and say, actually, I should think about doing this. I will think about doing that. I will ask AI, or I will ask a financial institution powered by AI to provide me a recommendation. But the initial requirement remains something which is emotionally driven, and it's a person-to-person business.
Isn't it just a matter of time, though, before that gets replaced? Because in a perfectly efficient market, I mean, that becomes the risk then, is if everything's machine-driven,
Absolutely.
then you have a perfectly efficient market because all machines are acting kind of rationally, at least within the rules that they've been given to do that. And then we lose the alpha in markets because then it's just,
I don't think, you're right. It is a massive risk, and it is the, I would say, standardization or the convergence towards the same kind of model for a person that age with 2 kids and things like that. There is the risk like that. But I actually think human beings are different. And I actually think that you will always have hedge fund managers seeking alpha. You will always have people in the insurance companies trying to protect and create financial safety. I actually think people are driven more than AI is driven. We drive AI. People drive AI.
That's supposed to be the idea for the moment anyways, yeah. How reliant are trading desks and capital markets firms today on AI? Like if you turned off every voice-activated AI trading assistant, how many desks are still in operation? How is this, 50% of the market is reliant on AI? What percentage would you say is?
I would say a majority. I would say that today you still have, I would say, the traditional algorithm. The algorithm which are not necessarily based on AI. They use a lot of computing power to actually do that. Algorithms are still very relevant today. Are they going to get replaced very quickly? Absolutely. There's that. The investment recommendations and effectively stock picking, market trends and all that, if you turn off AI today, will get impacted for sure. So the efficiency of it will be far less efficient. But is it going to come to a standstill and 50% of the shops would close? I would not think so. No, I think we're still in the big phase of discovery and adoption and trying to understand very specific business case for AI in trading, in banking, in asset management. I think we're still in an evolution phase, to be honest.
Right. Getting into the detail about how organizations are looking through that, say if you had a $10 million AI budget, how would you allocate that? Or how would you, let's look at this two ways. I mean, first of all, how are clients allocating it? And then how is that appropriate or inappropriate? Or how would you change that if you look at the split of this $10 million hypothetical budget across people, data, compute? What do you see in the market? What should it be in the market?
I think we need to look at it dynamically, right? If today, first of all, just to relate on what we talked about, if today you plan to invest $10 million, I think the business case is that in the next 2 to 3 years, this 10 million needs to become 6 or 7 to produce the same result. In typical, I would say, infrastructure way, the cost of today, what was yesterday a chip, what will be the cost of a chip is drastically going to come down as the adoption come up. That's number one. So I would say if you think about it today, wild guess, no data backed, I would say, decision here, but I would say 50-50 with infrastructure cost going down as the cost goes down for, I would say, with the production, people costs going up, because at the end of the day, you need to create that, you need to manage it, you need to do that. And if you think about it today, AI is kind of a self-learning. It's a very entrepreneurial kind of domain. I would not be surprised in 4 or 5 years, you would see courses at university where you have effectively degrees in AI and you have people with certification. So that will fuel the people aspect of it, and more financial institution and technology company will basically get AI-enabled personnel. So that cost will go up. The cost of infrastructure will go down. Overall, this should not cost $10 in 3 to 5 years. Otherwise, it's a little bit pointless. But that's how I see it.
It's interesting. I was talking with a friend about this, about AI replacing jobs, and he we always have this theory that you're supposed to teach your kids how to program, right?
Yeah.
That was the mantra a number of years ago, but now it's changed, and it's kind of unclear about what they're supposed to be doing. He suggested philosophy and history, because then you're learning how to think and how to ask questions, because that's going to be more important going forward rather than when programmers are replaced by the AI.
Yeah, I like it. And having an insight in the past and insights in the past to try to understand how the future is going to be is fantastic. I, however, believe that being technology enabled, it's a requirement. Like it's a real requirement for students, for kids, for any financial institution going forward, right? I mean, I remember when I came out of university, I was mathematically quite advanced, but technology I had to learn on the job. I had to learn how to code VB when my exams were on MATLAB. So that you still need to learn, and the coding aspect of it, although someone else can do it for you, I don't think it prevents. Well, I think it is a requirement for you to understand it, to understand how you can actually make it better and perform that. I don't think we can let the machine code and understand its coding and all of that. I actually think there's a high level of understanding of what is being produced is super important.
Be careful about mentioning all these programming languages. You're dating yourself seriously on many of these. But I mean, you talk a lot about tech. What about non-tech? What is the one non-tech change that has a better ROI than any model for an organization today? If they were to make a non-technical change, using AI? No, just completely divorced from technology. What is the one thing that firms are doing wrong today or should invest in today that's not technology to help them in the future?
It's interesting. I would think the real estate footprint of financial institutions today, completely outside of technology and outside of people. If you think about, a bank 15, 20 years ago, it was all about, I would say, the nice branch, your branch manager, and the infrastructure and the real estate you have around it. Today, I think the online presence, the online marketing, the availability, the intelligence, all of that stuff is much more important than how fancy your branch is and is it 200 meters away or 400 meters away. I actually think the real estate footprint of financial institution is still very important. It's going to become less and less important, and it costs quite a lot of money if you think about it.
I mean, speaking about Geneva, I remember going into Citibank's private wealth offices in Geneva, and that was an expensive real estate footprint, which I think probably needs to stay to a certain extent. We're getting into a section now that myth or reality, kind of a lightning round. And I'm going to give you a couple of statements and just want quick answers on true, false, what you think. AI desks will out-earn human-only desks by more than 30% ROI in the next 2 years.
True. I think it's a conservative assumption.
You think it's going to be more?
Yes.
RegTech costs will eclipse model training costs within 5 years.
True.
How so?
I actually think RegTech cost, the technology cost of regulation is a fraction of what the regulation compliance cost is for a financial institution. Actually, the cost is much bigger. So today, if you think about cost for regulation, it's not only technology. So if you compare it to training model, actually the cost of regulation is going to be much higher than training models.
A good technical one here. Cloud sovereignty rules will push AI trading back on-prem.
Data sovereignty rule might. The cloud by definition has to be a little bit international. Yes, countries are looking for answer inside at the moment rather than internationally. So going to on-prem might be exaggerated. Being very conscious of local rules and data sovereignty is something big, yes.
And then the last one, we haven't talked about tokenized assets yet, but tokenized collateral will make intraday liquidity risk obsolete.
It won't make it obsolete. It will making it much more efficient and transparent.
More efficient and transparent. Good. So to close things off, I just want to look kind of now into the future. So paint your 2030 trading floor. What does that look like in terms of the noise, the screens, the job descriptions, what's there, what's gone? What do you see as the vision 5 years from now for many trading floors? Or maybe it's not even a trading floor, it's a virtual.
I think, by the way, that's one of the issues with AI today is that we're all working on something and we need to have a vision, and that vision is something that needs to be built very, I would say, very quickly to be able to achieve the ROI that we intend to achieve, giving ourselves a goal and basically working towards that goal. Honestly, I see it completely automated. I see today you have high touch and low touch, for example, in trading. I actually think that frontier is going to disappear and it's going to be completely automated. So high touch, low touch disappearing, completely automated. I see, however, humans to understand and to monitor what is going on in terms of high frequency trading, in terms of expected outcome for the customer and the customer relationship, which I actually believe is going to stay as I would say, a differentiator to any financial institution, being in trading or in banking or in insurance or in asset management. I actually think that personal relationship is going to stay. The rest of it, which is the execution, the order taking, the market monitoring, the market data, all of that stuff is going to be a no touch.
Interesting. The listeners for the podcast will be listening to this on their run or on their way home or the way to the office. What is the one piece of advice that you would have for either on the technology side or on the business side of a capital markets firm when they get into the office at 9 a.m. tomorrow morning or 6 a.m., depending on what markets they're trading? What's the one thing that they should be focused on?
Get trained, be aware, take that train, because that train is here to stay. And there's no option to stay on the side. Get trained and getting an interest into it, not treating it as a vibe or fashion, if you want. When think about it as, I personally think that the AI revolution in the next 5 to 10 years is going to be, if not as big as was the internet. And if you think about the internet, those who actually did not embrace, I would say, a virtual or this kind of strategy 15 to 20 years ago, it is a difficult thing today to survive without effectively an online presence, right? And I think it's going to be the same for AI. Think about automation. Don't treat it as a viable or fashion. Treat it as something which is going to be there, and it's going to be there more and more. And the more you understand it, the more you can do anything about it.
So stay away from the pets.com equivalent of AI, but focus on the right ones. Francois, this has been great. Really enjoyed having you here today to talk through some of these
Thank you very much.
points around AI and capital markets. Thank you.
Thank you.